Holy cannoli, eggs and bacon, flipping my freaking pancakes around. What the hell is happening in the S&P 500? The markets are down about 2% today, but we have major recession signals that are going absolutely crazy today. The markets are really freaking out under the surface, and this is one economic lesson that you do not want to miss. So stay tuned, make sure you guys watch the whole video, save this video, or at the very least take some notes of these key things that we're going to be talking about so you guys can pay attention to them for yourselves, because today is absolutely wild. So let's get into this video. Hit that like button and subscribe to the channel. Thank you guys for doing that and helping to push these videos out to as many people as possible. I do love and appreciate every single one of you guys. So let's talk about Europe first and what has happened today. So the FTSE is down almost 3%, CAC down almost 3%, the DAX down 2.5%, the FTSE MIB is down about 2.5%, and the Stock 600 down about 2%. So it's a pretty big move down for Europe across the board, and that is because the French industrial production was flat in May, and PMI numbers throughout the Eurozone all showed slowing activity. But most importantly, the Euro slides to a 20-year low against the dollar as recession fears build. The euro shed around 1.3% for the session to hit $1.29 by mid-afternoon in Europe. The July Sentex Economic Index showed investor morale across the 19-country Eurozone has plunged to its lowest level since May of 2020, pointing towards, quote, an inevitable recession. The dollar strength continues, meanwhile, as risk-adverse investors seek a safe haven and the U.S. Federal Reserve embarks upon what looks to be an aggressive rate hike regime. Now, there's a lot of implications and reasons why currencies like the euro will strengthen or weaken relative to the US dollar, but to keep this Econ 101 friendly, when the euro weakens comparatively to the dollar, and when the dollar is strengthening, that is showing that people want US dollars. People want that level of safety, because where else do you go to get that level of safety? There's nowhere else you can go that is as safe as, believe it or not, the US dollar. And specifically when the Fed is raising rates at such an aggressive pace and Europe is unable to do that, and they even have higher inflation than us, it makes a lot of sense why people want US dollars. And that's actually a bad thing for the US, because it's going to make the conversion rates a lot worse for companies selling things abroad. So to keep this all Econ 101 friendly that everyone can understand, when the euro drops, it is not good. The euro is supposed to be stronger, much stronger than the US dollar. And long story short, Europe has very high inflation, higher inflation than America, and they are unable to raise rates as aggressively as America can because they're in a much worse economic situation. So that's the long story short, the Econ 101 version of all of this. You could leave your thoughts down below. There's a lot you could talk about when it comes to foreign exchanges, what it will do for certain sectors of the economy, for certain industries, certain stocks that will benefit, some stocks will not benefit. Leave your thoughts, whatever you have to build on that down below in the comment section. But that is something that is very important, that is really hurting our markets here today as well. Now, on top of that, you almost have the 2 and 10-year yield. This is the inversion, right, that everyone talks about, the 2 to 10 year. It's essentially econ. Let's keep this Econ 101 as well. It's saying when you can get paid more out of a 2-year bond than a 10-year bond as far as the interest rate, well, that is showing signs of deflation. That is showing signs of fear in the short term. And when this goes negative, it is almost always predicted a recession. Even strangely enough, back here, August 27th, 2019, the 2 to 10-year yields did invert. And what happened about 6 months later? You had the COVID recession. So there's a lot of theories about that. Maybe someone knew it was coming, whatever the case is, but you still had a recession even back then. And the yield curve curve did invert actually on my birthday, April 1st, 2022, on a Friday, and inverted by about 0.05%, which was actually a deeper inversion than what we seen back here in 2019 before that COVID recession. Now we are almost inverted again. You only have a spread of 0.04 basis points here. As far as July 1st, it's even closer to being inverted here. I believe the spread is only 0.01 here today, and that is also a sign that investors are fearful, buying up the 2-year bonds. So there you have that. Those are two very, very important things. But at the same time, you also have the dollar, which is strengthening in a big way. And if you guys look at the COVID crash that we've seen back here in 2020, it's pretty self-explanatory. This is the easiest one to really, get down to know. What's happening and what this means, essentially. Like when you're talking about different currencies, what it means compared to the dollar, that's different. But just look at the dollar here. The dollar in COVID, it spikes because everyone wants that safety. Well, what has been happening in 2022 is the dollar has been consistently spiking, and it's actually up 1.6% today on a pretty parabolic rally over the last couple of months or so. So it looks like the fear is definitely building, and we could get a pop-off kind of event like we seen during the COVID crash, and that's when you could try to confirm a bottom. When the dollar really, spikes up like this, that's when you are more than likely at a bottom. We are not there right now. It has just been a slow and steady move to the upside, as investors do want that degree of safety. Now, here's something that everyone should understand and be able to relate to. So when you get a recession, you get the price of oil, which starts to plummet, which is happening today. Oil is down more than 8% and breaks below $100 as recession fears mount. That is the breaking news headline here on CNBC. So what do you expect to get during recessions? Well, you expect to get deflation, and usually deflation in a massive way. At the same time, the Fed is doing quantitative tightening, and they are trying to reduce the overall M2 money supply, which is currently sitting at about $21 trillion, give or take, whenever you guys are watching this video. It does move around a little bit every single day. But long story short, if the bond yields, the 10-year treasury, the one you can see right here on CNBC, if this is going higher, that means people are not as fearful about a recession. They are more fearful about inflation, because if inflation was 5% per year for 10 years, why would you take a 3% bond yield? Because you're going to lose a lot of money in the course of 10 years. Well, if you are fearful about growth in the economy, about a recession, and you think potentially a recession is coming and you might get deflation, at the same time the Fed might reduce some of the overall money supply, well, a 2.80% 10-year yield does not look all too bad. Granted, if you expect a recession, if you expect deflation sometime over the next couple of years. So when you see the bond yields coming down, especially when the Fed is raising rates, that shouldn't be happening. That is happening because investors are buying the bonds. It works like a dividend stock, right? If a dividend stock, let's say the stock is $100, but it pays out 5% per year, well, that means it pays you out $5 per year. Well, if that dividend stock were to fall to $50, well, now they're still paying out $5. They're now paying out 10%. Right? Just the value of this dividend stock, it fell, so now you get paid out more. Well, when people start to buy up that dividend stock, let's say that dividend stock is now trading at $200, that stock doubled up. Well, now the bond yield is only 2.5%. So there is a little lesson right there. But the bond yields have come down sharply since that last CPI reading we got at about 8.6%. You've come down from 3.5% on the 10-year treasury down to 2.79%, like I said, in a very short amount of time. A pretty historic overall move to the downside, as investors are fearful about a recession, and bond yields are down 0.11% here today alone, and oil is down a lot, like I previously said, and that's why markets are really freaking out here today. You're seeing clear signs of a recession, and while this is not so good for the stock market, the question then becomes, how deep, How long? How much bankruptcies? What's the unemployment rate going to be? When is the Fed going to stop raising rates? Those are the questions the markets will start to ask. And depending on what we get out of the minutes tomorrow, that could give us somewhat of an indication of what to expect. Now, if you guys are unfamiliar of what the Fed minutes actually are, well, it comes out at 2 p.m. tomorrow. And it's basically a transcript of what was said at the last Fed meeting. What the markets are obviously going to want to pay attention to is, what did the Fed have to say about a recession? How aggressive does the Fed think they can get? And if the Fed is still talking very, very aggressive, as you are seeing clear signs that the markets are fearful about a recession, well, that could mean more short-term pain. But the light at the end of the tunnel is that when you go into a recession, when, the price of energy falls, when the bond yields are falling, it makes credit and capital not as expensive, right? When the U.S. 10-year Treasury is trading at 3.5%, it's a lot harder to go out and get loans. You get more of that demand destruction. Mortgage rates were over 6%. Well, mortgage rates have started to come down because the 10-year Treasury has started to come down. So it can actually spur some economic activity, just markets being fearful about a recession alone. So the FOMC minutes comes out tomorrow at 2 p.m. That's either going to help things a lot or hurt things a lot. What could be very bullish for the markets would be the ISM non-manufacturing PMI. If that comes down, and the job jolt openings, if that comes down, that could be very good, because it could say, hey, maybe the Fed won't have to raise rates as aggressively. But if we get good job numbers and we get, PMI that is still very high, well, that's going to be a recipe for disaster coming tomorrow for the stock market. Now, on Thursday, you have more important data. ADP employment change for June and the balance of trade for May. We're expecting an $87.1 billion trade deficit. That's going to be very important. Germany just had their trade surplus actually come down, so that's not a good thing. That actually happened today, and that is something that helped really deteriorate the European market. So that will be important for the odds of a recession, because after all, the Atlanta Fed Now GDP tracker is estimating a negative 2.1% GDP print for Q2 2022. So just coming here July 28th, we're going to get the advanced estimates for Q2 GDP. And if we come in even close to that, even negative at all, the markets are going to freak out, because we would then be in a technical recession. At the same time, the day before that, we will have the Fed that is expected to raise rates by about 75 basis points, and the actual odds of a 75 basis point rate hike went from 93% over the weekend, now only down to 82.6%, as the markets are getting more fearful about a recession. But we are firmly pricing in 75 basis points, so it looks like that is what we are going to get, as the Fed does listen to what the markets are pricing in, and they like to do what the markets are pricing in. But you have this July 27th, Fed raising rates. You have the advanced estimates for Q2 GDP confirming if we could already be in a recession coming the day after, July 28th, and then you have big company earnings mixed in here and there. I think the real icing on top, if you guys are looking for a crash, the flush out event, the margin calls, all of that, and looking to set a bottom, it would be after this, some point in August, if company earnings are really bad. If Apple, Microsoft, Google, Amazon, Tesla earnings, if they're all bad and you see margins really coming down in a big way, well, that is going to probably mark the bottom. That's probably going to be that big flush out event that we have been waiting for. Now, as far as Friday and economic data, you do have the non-farm payrolls for June and the unemployment rate for June as well. Participation rate, average hourly earnings, month over month, year over year. A lot of other data in that regard. And you do also have Fed Williams that speaks at 11 a.m. on Friday. And I believe you have Fed Williams, and is it Fed Bostic that speaks tomorrow? No, you do have Fed Williams right here that I see, and I believe you have someone else that is speaking with like a news outlet or something along those lines. I believe you have two Fed speakers tomorrow, but Fed Williams will be important. That is at 9 a.m. before we get that economic data, the JOLTS job openings and ISM non-manufacturing PMI that comes out at 10 a.m. for tomorrow. Now, the two last things that we're going to touch on are really, really important. So some of you guys might be wondering why you are seeing some high growth stocks, some stocks that are projecting really high growth rates over the next couple of years, actually outperforming today. A lot of our portfolios are probably in the green today, believe it or not, even when the markets are down a lot, right? Your Affirm, Snapchat, a lot of stocks that I invest in, Fubo, just Square, all of these stocks are pretty much positive on the day. Some of them in between 3 and 6% positive or more. And that is because when you have fears of growth slowing down, if investors are looking at a stock and say, hey, this stock is expected to grow 25% per year over the next 5 years, even if you discount that and say they're only going to grow at 12.5% per year, well, that's a lot better than no growth in the economy, right? So that's a reason why growth stocks tend to outperform during recessions. But also, this is something that is very important. If you look at the S&P 500 and the actual option chain for this week, the open interest on the call side is 38.1%. The open interest on the put side is 61.9%. But if we look out to July 29th, keep in mind, we're going to have large company earnings that whole week. You're going to have the Fed raising rates on the 27th and the advanced estimates for Q2 GDP coming out at the 28th, the time period in which I do expect the markets to see some pretty substantial downside. If you go ahead and look at that expiration for July 29th, for the call side, you have 22.88% open interest. And for the put side, you have 77.12% open interest. So out of the total amount of calls and puts that are on the expiration of July 29th, only 22.88% of those are calls. 77.12% are puts. So this could actually help us to get some of that downside, and I think this is something that really shows you guys and could lead you in the right direction, at least what the markets are expecting over the next couple of weeks. And it obviously looks very, very negative. All of these options do have more negative, more puts on the option chain than calls, but specifically that July 29th expiration has a lot more puts than calls. So that is going to be all for this video. That is really what you guys need to know. You are seeing a lot of call activity, as you can see, coming in right here as people are trying to bid up the markets. I think one last time, probably to short the markets back down, if I were to imagine, coming throughout the rest of this week. Typically something you see before a big data catalyst event, which will be the FOMC minutes coming tomorrow. So thank you guys for watching. Hit that like button and subscribe to the channel if you guys found value out of this video. If you didn't understand something, or if you want to add something to this conversation, post it down below in the comment section. No comment is a bad comment, especially right now. So thank you guys for watching. Get your free stocks down below in the description with Webull, Moomoo, and Public as well. I will see you guys in the next one.